Okay, let's unpack Hull's latest results. It's a real tale of two very different profits. Story number one starts with this huge number, a 121% jump in their total net profit. I mean, that looks incredible, right? But is that really the whole picture here? Because story number two is this, a 30% drop in their actual day-to-day operating profit. So, wait a second. How can both of these things be true? Let's figure this out. And this really sums up the whole puzzle. You have a massive gain on one side and operational struggles on the other. All right, let's tackle the good news first. Where did that 121% even come from? Well, it's from something called a one-off gain. So this isn't from their regular business. Specifically, they spun off their ice cream business. That's what pushed their total profit way up. Okay, but what about their actual core business? Well, revenue was up, which is good news. That means they actually sold more stuff. The volume of products they sold went up. All right, now for the other side of the story, that 30% drop we talked about. This is what really shows how healthy the core business is, making and selling things. So why the drop? Basically, their cost to make things went up and they had to lower some prices. And here's the key, their actual profitability, their margin, got squeezed. It went down. But it's interesting, not every part of the business felt the same kind of pressure. Home care, for example, absolutely crushed it. We're talking record market share here. And check out premium beauty and personal care. That was a real growth engine for them. The foods division was a bit of a mixed bag, though. Coffee was strong, but tea really struggled. Okay, so when you put it all together, what's the big takeaway from all this? The big lesson is to always look past that shiny headline number. It's just not the whole story. Because digging just one level deeper can tell a totally different story. So what will you look for?
Okay, picture this. You're hiking, and you're standing on the edge of a massive cliff.
Okay.
You look back over your shoulder, and the path behind you is flat. It's been boring for miles, honestly.
A little bumpy, maybe.
Yeah, a few rocks here and there, but generally safe, flat ground. Then you look forward, you take one more step, and the ground just, it disappears.
That is a pretty dramatic image to start with.
It is, right.
But looking at the source material we have in front of us today, I'd say it's not an exaggeration. It's entirely accurate.
It feels appropriate because we are looking at a snapshot of a financial chart for Hindustan Unilever. The ticker is Hindu Unilever on the National Stock Exchange.
And the date is Wednesday, February 11th, 2026.
Exactly. And looking at the far right of this image, there's just this massive red block just plunging straight down. It looks like a skyscraper toppling over.
It really does. And what's fascinating here is that, to the untrained eye, it just looks like a red line going down. A bad day, sure. But to a technical analyst, that red block, which we call a candlestick, is screaming a very specific, very loud story.
A story of what? Panic.
Panic, conviction, and a broken market structure. All of it.
And that is our mission for this deep dive. We aren't just talking about one stock. We're using this image, this Nuvama platform interface, to decode how you can read the vital signs of a market.
Precisely. We want to help you look at a chart like this and not just see lines, but see the emotion, the psychology, the money moving behind them.
And there's a lot to see here. We have the main price chart with these candlesticks.
We have the Bollinger Bands. Those green lines acting like an envelope. We get a moving average, that red line.
And then below that, the RSI indicator and the volume bars at the bottom. It's a whole dashboard.
It is.
So let's unpack this. Before we get into all the fancy indicators, let's just look at the headlines, the raw numbers at the top.
Right. Because the numbers themselves tell a pretty brutal story. So for February 11th, 2026, the data tells us the stock opened at 2475 board is 00.
Okay, 2475. That's our starting line.
Yeah. Then it went up just a tiny bit to a high of 2479.60.
So what, 4 rupees? That's nothing.
Practically nothing. Basically, the market opened, buyers took a sniff, and immediately just gave up.
That's a bad sign right there, isn't it? When the bulls can't even get it moving at the open.
It shows a complete lack of enthusiasm. And then, well, the floor gave way. It crashed all the way down to a low of 2350.10.
Wow. From almost 2480 down to 2350. That is a huge drop for a blue chip stock like Unilever.
These are the steady eddies of the market. You buy them for stability.
Right. This isn't some volatile tech startup.
Not at all. A move like this is significant. And then it finally closed the day at 2358.80.
So just doing the quick math there, The gap between where it opened, 24.75, and where it closed, 23.58, is, well, it's over 100 points.
It's a massive percentage drop, and that gap, that physical distance on the chart between the open and the close, is what creates that big, thick red body of the candle we're seeing.
I want to pause on that because I want to make sure everyone really gets this candlestick idea. If you've only ever looked at, the squiggly line charts on the news, candlesticks can look a bit archaic.
Which is funny because that's actually where they come from. But they are the standard for a reason. A line chart only shows you the closing price.
It's like reading the final score of a game but not knowing how it was played.
Exactly. A candlestick shows you the highlights reel. Think of it as having two parts. You have the body, which is the thick block.
The red part in this case.
Right. If it's red, it means the price closed lower than it opened. The top of the block is the open, and the bottom is the close.
So the length of that block represents the momentum of the move.
Yes. So size matters here.
I was just about to say that.
Size absolutely matters. A tiny little block, that's indecision. A huge block like this one, that is dominance. That is sellers driving the car with their foot on the floor.
And what about the thin lines, the ones sticking out of the block? They look like the wick of a candle.
Wicks, or shadows, is the technical term. They show you the extremes of the day, the highest high and the lowest low. They represent the struggle.
Okay, so on this chart, there's a tiny, almost invisible wick at the top.
Which tells us the bulls, the buyers, had zero power. They tried to push it past 2x475, got to 24.79, and were just immediately slapped down.
And then at the bottom, there's a slightly longer wick. The price hit 2350.10, the absolute low, before bouncing up to close at 2358.80.
And that little bottom wick represents a bit of a fight at the end of the day.
A fight, or maybe a rescue mission.
Well, that's the question, isn't it? It tells us that when the price hit 23.50, some buyers did step in and say, okay, this is cheap enough for me, and pushed it back up 8 points.
But let's be real, 8 points is not much when you've just dropped over 100.
No, it's not. It's like putting a Band-Aid on a broken leg. The sellers won this day, hands down.
So we have the disaster of the day, February 11, but context is everything. Let's look in the rearview mirror. This chart goes back to October 2025.
Right. And if we scan back to the left, looking at October, the stock was trading significantly higher. You can see those peaks. It was a different world.
And then came the winter slump. It looks like a staircase going down into a basement.
A classic downtrend. Through November and December, you see it stair-stepping downwards. Lower highs, lower lows. It's a slow bleed.
But then look at January of 2026.
Yeah.
It stops dropping. It just starts going sideways.
This is what technical analysts call consolidation. The market is taking a breath. The sellers are tired, but the buyers aren't confident enough yet.
It looks incredibly boring, just these small green and red candles shuffling along. It seems like nothing is happening.
And boring is often the most dangerous time in the markets.
Oh, I like that. Boring is dangerous. Why? Why should I be worried when nothing's happening?
Because energy is building up. Think of it like coiling a spring tighter and tighter. The longer it stays boring, the more violent the move will be when it finally breaks out.
So silence isn't peace, it's preparation.
Exactly. And I see a red line snaking through those candles. It looks like it's following the price. What is that?
Yeah, that red line seems to be like magnetizing the price in January.
That is a moving average. It's basically a smoothed out line of the average price over a certain period. It filters out the daily noise to show you the real trend.
Like a baseline or a center of gravity.
A center of gravity is a great way to put it. If the price is above the line, it's generally bullish. Below, bearish. And in January, look how the price is tangling with that red line.
It's like it can't decide if the line is a floor or a ceiling.
That's a great analogy. It's testing it. But on February 11, the decision was made. That big red drop slices definitively below the moving average. It has rejected it.
Okay, so the moving average gave up the ghost. But what about these other lines, the green ones that are wrapping around the price?
Those are the Bollinger Bands. And honestly, for this specific chart, they might be the most insightful part of the story. If you want to understand why the drop was so violent, you have to look here.
Bollinger Bands? It sounds complex. But visually, it's just a top green line and a bottom green line. What are they measuring?
They measure volatility. Think of them as the guardrails on a highway. The width of the road changes based on how wild the driving is.
So if the price is swinging all over, the bands get wider.
Exactly. And if the price is quiet, the bands contract.
And what happens when the road gets narrow? Because looking at late January, just before the crash, those green lines get really, really close together.
That is the famous Bollinger Squeeze.
Yeah.
And remember what we said about boring being dangerous?
A coiled spring.
That's it. When the bands pinch together like that, it means volatility has dropped to historic lows, the market breathes in, and then it has to breathe out.
So when you see the bands squeeze tight, you know something big is coming.
You know something is coming. You don't know the direction just from the squeeze, but you know an explosion is imminent.
And then we look at February 11th. Boom! The explosion happened downwards.
It did. The price didn't just drop, it crashed through the lower green band.
Yeah.
We call that a breakout.
It's like the car didn't just hit the guardrail, it drove right through it and off the road.
A perfect analogy. When a candle closes below that lower band, it's a sign of extreme weakness. This wasn't a drift lower. This was a violent expansion of volatility.
Okay, so let's recap. The price chart is telling us disaster. Moving average says trend broken. Bollinger Bands say volatility explosion. But you always want a second opinion, right? Let's look under the hood. There's that middle panel labeled RSI 14.
Right. RSI is the Relative Strength Index. It's a momentum indicator. It tells you how fast the car is driving.
And on this chart, it's just a white line that looks like a mountain range. How do we read this?
Look at the trend of the white line in January.
It was actually going up, wasn't it? Even while the price was flat.
It was. That's a keen observation. It looked like maybe, just maybe, the buyers were quietly gaining strength.
It was a head fake. It tricked us.
Completely. It lured people in. But then look at the far right of the RSI panel now. What do you see?
It looks like a hook, a sharp, jagged turn straight down.
That hook mirrors the price drop. But here's the really critical part. For anyone thinking, hey, the stock dropped 100 points, it must be cheap now.
Right. The temptation to buy the dip.
That's the clearance sale mentality. But look at the value. The grid lines are usually 70 at the top and 30 at the bottom. 30 is considered oversold.
And where is this white line sitting right now?
It's nowhere near the bottom. Judging by the grid, it's hovering somewhere around, what, 40 or 50?
Wait, so even after that massive crash, the math says it's not oversold yet.
Exactly. And that is the scary part. It implies there's still room to fall before the stock is mathematically exhausted.
That is sobering. So don't try to catch a falling knife, as they say.
Not based on the RSI, no. The momentum signal confirms the price signal, down.
Okay, let's move to the final piece, the bottom panel. The volume. I always hear traders say volume is the truth serum. What does that actually mean?
It means volume validates price. It separates the fakes from the real moves. Imagine if the price dropped 100 points, but only 10 shares were traded.
Then it's not real. It's just a fluke.
Exactly. It wouldn't be sustainable. But if the price drops 100 points and 10 million shares are traded, that's conviction. That's the market speaking with a megaphone.
So let's look at the bars at the bottom. We have a forest of little bars in January, and then
the anomaly. Look at the final bar on February 11. It is red, and it is significantly taller than any of the bars that came before it for weeks.
It towers over them. It looks like double or triple the average height.
That is the confirmation. This wasn't a mistake. This was a high-volume sell-off.
Yeah.
It means big players, institutions, mutual funds, the smart money were likely hitting the sell button.
And when the big money sells, they usually have a reason.
Precisely. High volume on a down day is the strongest bearish signal you can get. It says, we are getting out and we are doing it at any price.
So putting this all together, it's like a detective story. We have the suspect, the price drop, and we needed witnesses.
And the witnesses are all lining up and they're all telling the same story.
The consolidation phase lulled everyone to sleep. The Bollinger Squeeze loaded the gun. The price breakdown fired the gun. RSI says we aren't done falling, and volume says we are deadly serious.
That is a perfect synthesis. Hindustan Unilever spent January resting, and on February 11th, it made a violent downward decision.
It really shows the value of this kind of analysis. I mean, we haven't looked at a single news headline. We don't know why this happened.
We don't need to. The chart reflects the sum total of all market knowledge. The bad news, the sentiment, the panic, it all shows up right here in the price action.
It's almost like a language. Once you learn the grammar candlesticks, bands, volume, you can read the story.
It is a language. And like any language, it's about nuance.
Speaking of nuance, I want to circle back to that little wick at the bottom of the candle one last time. That bounce from 2350.
Yes, the 8-point recovery.
In the grand scheme of things, it seems insignificant, but does it matter for tomorrow?
It matters because of where it happened. 2350 is a round number. Humans love round numbers.
Psychological support.
Exactly. So that bounce tells us there were some buyers waiting at 2350. The question, and this is the provocative thought for you to consider, is whether that was the start of a genuine rescue mission or just a dead cat bounce.
A dead cat bounce. That is a horrible visual.
In a morbid Wall Street term, but it's effective. The idea is that even a dead cat will bounce if you drop it from high enough.
So just because a stock bounces slightly after a massive crash doesn't mean it's alive.
It doesn't mean the recovery started. It might just be physics.
So the question is, was that Wick the Bulls stepping in to save the day, or just a pause before the bears pushed it even lower?
The chart reveals the battle, but not the final victor. We need to see the next day's candle to know for sure. But given the volume and the broken momentum, well, the odds are stacked pretty heavily against the buyers.
Well, there you have it, a deep dive into a single day of drama. It's amazing how much you can learn from one image when you know what to look for.
It really is. It turns a chaotic market into a decipherable puzzle. And once you see the pieces, the squeeze, the volume, the wick, you can't unsee them.
Thanks for breaking it down with us. For everyone listening, pull up your charts, check those Bollinger Bands, and watch out for those dead cats. Catch you on the next deep dive.